Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus Hodgson, your host. Pleased to be with you, joined by Brian London in New Orleans. And we have one of our favorite guests back on. He's a regular speaker at the New Orleans Investment Conference. He is Nick Hodge, founder and president of the Outsider Club and investment director of Wall Street's Underground Profits and Early Advantage. He's also authored 3 books, at least 3 that are listed on Amazon: Energy Investing for Dummies, How to Really Get Rich in America, and Investing in Renewable Energy, Make Money in Green Chip Stocks. Nick, welcome to the show.
Fergus, thanks for having me back. Appreciate it.
Great. And we were just chatting before the start of the show about how, you seem to have made a bit of a name for yourself in energy, even though you're agnostic, you're interested in many sectors. One topic that has been getting more attention lately is this ESG, environmental, social, and governance investing, or ethical investing, and you mentioned that you've known it as triple bottom line investing. Maybe one of your concerns is that people get attracted to maybe an ideological argument rather than a bottom line argument. Do you want to clarify your view on that?
Yeah, sure. I think that I'll take it back to when I first started in energy back in around 2007. And if you close your eyes and think back to then, those were the days of like Yingli Solar and JA Solar being the most heavily traded stocks on the NASDAQ, right at the top of the column on the back page of the Wall Street Journal. And so I very much jumped into this renewable energy market when it was screaming higher and it was very popular, even then with the Al Gores of the world and a belief that we had to convert our global energy production fleet to green power. And so I saw even then the phrasing of these terms. I would refer to it as triple bottom line is how it was always framed to me, right? Where you're thinking of the climate and social impacts as well as the ultimate, black or red bottom line. And I understand why it's become even then and why it's popular now, but we've seen so many examples of it simply not working out. And I've even seen examples of funds closing that were opened up to cater to this sort of quote unquote demand where the demand doesn't materialize. So it's great, like you say, ideologically, and it's great for folks that are narrative driven. But at the end of the day, really, there's one bottom line, or at least there used to be. Maybe we'll talk about stocks that aren't profitable now that seem to go up. But no, for me, when I make an investment, I would like it to perform financially. And while I think about the earth and I think about being sustainable on a personal level, I certainly don't let that dictate my personal investments or the investments I recommend in my newsletters.
I noticed your book, Investing in Renewable Energy, had impeccable timing. October 8, 2008 was its release. So was there an evolution when you went to your second, the Energy Investing for Dummies, which came out in 2013? Well, you were the chief author of the second one, so I assume you had much more authority over what went into the book.
I mean, that's correct, but there's always a framework to the dummies books and the topics you have to write about. And of course, a lot had transpired in the world. A lot of clean tech stocks, wind and solar stocks had been, ravaged at that point. Gamesas of the world, et cetera, the Vestas, those all crashed in 2008, 2009. And then, of course, we had the fracking boom in the United States that allowed us to really diminish the amount of reliance we had on foreign oil. And I think so. It was a couple of things going on. It was a natural evolution of the markets, one. Two, I was a very, very young gentleman when I was adopted to write that renewable energy book, right? I was probably 24, 25 years old. And so right. I didn't know anything about the markets, and I would argue I probably still don't, but
and you were a gentleman back then, yeah?
No, I used the wrong word, Brian. Thank you for stepping in.
That's what stopped me back then.
a young man, a young man, not a gentleman. And so, you learn things about the market, and you learn things about the world, and you have a coming of age with your worldview. And I think all those things were happening in the evolution of my beliefs and the things I was writing about the energy markets.
One of the things in that ESG that I think has evolved that I find interesting, and I've always subscribed to your view that you need to choose investments based on the real bottom line and how they perform in the real world and profits and potential and everything else, and not so much for these ethical views that really are fluid, from one person to another. One thing may be ethical for me and may not be ethical for you, and vice versa. So it's hard to define to begin with. But this trend has grown so much money flow, at least in the more generalist investors and markets, into these ESG sectors or investments, that they're starting to demand a premium. And by virtue of just that, they're either narrowing that performance gap, if not totally eliminating it. So I do think it's something to bear watching, that some people are willing to give up potentially something in terms of performance to invest in areas that they feel good about. And by doing so, they're actually willing to pay a premium or lose a premium on their investments, lose that performance. So there's more money flowing in, and some of those areas end up outperforming because of it, because of no other reason. But the other issue, again, is how do you define an ESG investment? How do you find an ethical investment? The definitions are fluid, and they vary from one investment and one person to another. So people have to really look behind the scenes to see what is actually being invested in. And sometimes, like you mentioned, an investment or a government or somebody tries to be ethical, like Germany with uranium, and ends up using more coal as a result. These unintended consequences when you try and defeat the free market and allocate resources in ways that aren't most efficient, but are according to your political views, they end up having very often the reverse effects of what you intended.
It reminds me a lot of the mantra for, quote, fair trade, because it's very hard to define. And yeah, as I look into that, I never really get a good answer as to what that means. But one argument I hear, and this is where Nick's mention of what he called narrative investors or narrative investing, was that this actually in the long run will pay better returns. Is that just pie in the sky or lofty thinking? It just makes people feel good?
I mean, I haven't seen the returns be outsized relative to their peers for these social funds at all. And it sort of depends on what they hold, right? I mean, let's take a step back for a second and look at the market. I mean, the broad-based equities are at like a 10 or 11-year high. I mean, what's not at a record high right now? So sort of any fund should be doing, quite well right now. The other thing I'd say is let's take a look at what some of these funds hold, because if you drill down on, what's quote unquote an ethical or socially responsible or, whatever, like Brian says, it's tough to define what these ethics even are. To be a fund, you still have like fiduciary standards, and there still has to be, standards of the size and the liquidity of the companies you invest in. And so if you go and really drill down on the holdings of a lot of these funds, I mean, most of them they're still going to hold things like, I don't know, Google is one I see a lot, because their mantra is like, don't do evil or whatever. That's why they get put in the socially responsible fund. But how can you really argue that like Google is an ESG company? Or I'm certainly not in the energy field, but, because, maybe they're making investments in biotech that's going to cure some disease or something, they get included in this fund. But ultimately, I would argue they get included. It's not because of, what they're doing for the triple bottom line, but it's because of the requirements of the fund. And so these big companies end up getting put in the funds anyway. And so they perform as well as, whatever their holdings or the S&P or their peers.
Yeah, and you make a good point. In an era when central banks and just unprecedented levels of liquidity are driving all markets higher, even markets that used to be uncorrelated with each other, yeah, it's easy for anything to have performance. But when you have more mixed markets, and you can get away, or will have to get away, from passive investing into more active investing, that's where the rubber meets the road, and we'll see how well these ESG type investments actually do perform.
Well, one of the concerns to me is that many of these funds obviously are going for investments that depend on subsidies or tax breaks, so they're more politically vulnerable. Do you consider those elements when you look at your own energy investing?
Oh, for sure, man. And we can get back to what Brian brought up about Germany. Let's just take them as a case study, for example. So, back in the day when they had all the subsidies for solar, and that was the hot market to be in, right? What happened? Let's lay out the positives and the negatives. Well, it allowed Germany to become the largest solar market in the world, right? That's a good thing. Was it economic? Well, maybe not quite. Germany is now paying in 2019, 2020, the highest electricity rates in Germany at the retail level. And so, you can argue both sides of that. Do you want higher electricity prices, or do you want a higher level installed clean energy base? The other thing Germany did is after the Fukushima incident, and this is what Brian was referencing, is they decided to make a push to close down all their nuclear plants, which we now know with 10 years looking in the rearview mirror was a wrong-headed decision, in that they ended up burning much more coal, and the dirtiest coal at that, lignite. Emissions went up, and now there's reports coming out of U.S. universities, like progressive universities, right? Like Berkeley, for example, saying that was what I just said, a wrong-headed decision. Your guys' emissions went up, and as a result, thousands of lives were lost due to related respiratory issues, particulate matter, et cetera. And so, to get back to your question, yes, that's something I look at very much. And sometimes it's hard to see, the forest for the trees, right? Like in 2007, we thought the solar subsidies were good, but here we are a decade and a half later, and we know that maybe they weren't so good. And then I would harp back on what I was saying before, that you learn lessons over time, right? And you come of age in the market, and you get to have a sense of, at least I do, of what works and what doesn't, and what's going to pan out correctly. And that's sort of, it's like that market intuition, right? That guys like us, I guess, have or think we have sometimes.
Yeah, when you look at the unintended consequences in investing and all of these seemingly holier than thou or people trying to socially construct investments in technology and the like, there's so many other examples, like the movement against genetically modified foods. There's been this big outcry, and it's really stunted the growth and implementation of golden rice that has been genetically manipulated to provide vitamin A, which is a really deficient vitamin throughout much of the developing world. The implementation of golden rice has been really stunted. And as a result, there are hundreds of thousands of people who have either died from vitamin A deficiency or losing their eyesight around the world every year. And nobody really talks about those consequences. They banned DDT, which was a wonderful thing for the environment decades ago. But if it was allowed today, it is the most effective insecticide. If it was allowed today, where you could actually have a spritz of DDT in people's huts in Africa once a night, then there would be literally hundreds of thousands of people would live every year that would not get malaria. And, all the other methods are much less effective. So these kinds of unintended consequences, these socially constructed policies, have real life consequences where people actually die because of them. And people don't understand that in Germany. People are dying every year because of that feel-good policy of moving away from nuclear energy. And that could be replicated around the world, that example.
And I think you'll see backlash to it. It might not come as fast as I and maybe others would like, but, that's sort of like the ebb and flow. Like the market has cycles and the precious metals market has cycles. Well, so does like public sentiment, right? And how they feel about government and draconian laws and top-down strategy and et cetera. And so you're starting to see pushback now, right? There's people saying, environmentalists especially, we need to embrace nuclear energy. It is baseload and it is clean. And so, there's sort of this, well, back and forth, right? And I think we've had back for a lot on nuclear now for a decade or so, and it's time to have some more of the fourth.
The Gold Newsletter podcast is proudly sponsored by the Discovery Group of Exploration and Development Companies. To learn more about our exceptional track record and exciting future, visit discoverygroup.ca.
Hello, listeners. Welcome back to our weekly interview with the Discovery Group, which is a proud sponsor of the Gold Newsletter podcast. Each episode, as you all know, we interview one of the Discovery Group companies. I am Daniel Duarte, and today I have the pleasure of having again Tom Martin, Director of Corporate Development at Ethos Gold, a resource exploration company with projects in Quebec, British Columbia, and Nevada. Tom, glad to have you back on the show.
Thank you, Daniel. Pleasure to be here.
So in January, when we had our last call, you said you were moving forward with 2 exploration programs at your gold project in Quebec. Is there any news on that front?
I can report that we just last week completed the second phase of drilling. So now we've got all of our samples in for assays. We anticipate our first assay numbers to come back middle to late next week. So we hopefully will have an announcement to make. We're certainly encouraged by the mineralization that we're seeing. But as you know, assays are the telltale. So we look forward to see what we have.
Yes. And what about Perk Rocky, your other project in Canada?
Well, Perk Rocky here in central BC is a real exciting project for us. We had some flow-through money to BC funds to spend because our vanadium project was put on hold. So we looked for the best project we could, and we certainly have been very, very excited about the project we chose. After our field program of last year, we're very confident that we're sitting on a never-drilled copper porphyry system. We're currently planning this year's drill program, and I can say that we've had quite a bit of interest from larger major companies on the property. So with PDAC coming up this week, we'll be having discussions with various companies about a possible participation in Perk Rocky with us.
Interesting. In our past interviews, we have usually focused on Quebec and British Columbia. What can you tell me about the project in the US, in Nevada?
Well, our Iron Point project in the Winnemucca area of Nevada, we did do some deep drilling there last year, and we hit some gold. I wouldn't say the numbers that we would get excited about, but I can confidently tell you that in late January, our team of Craig Roberts and our VPX, Joe Price, met with our consultants and partner, Quentin Henning, and a new consultant we hired, a gentleman named Louis Teal. Mr. Teal is a fairly well-renowned Carlin gold expert. He's a very experienced geologist. We had access to our joint venture partner, Victory Metals, on their drill program. They're a vanadium company, but we got all the access to their upper-level drill results combined with our deep drill results and some geophysics. We're very confident that we are in the right area. We just haven't hit it yet, but there will be a new modeling done, which is currently being done by Lou and Joe and Quentin to further define our targets for this year's drill program. Everybody's very excited to get back on it because we certainly do believe we're in Carlin country, as we put it. And our faith in the project is stronger than it has been before.
Perfect. So 2020 continues to be a good year for gold, surprisingly. Has that price bull run translated into more interest in the junior mining industry, or will that take a little longer?
No, I think the interest is there. No, I'm basing my opinion on some of the recent conferences I've been at since the beginning of the year, and the excitement level and the flow of funds to junior mining companies from institutions is stronger than it's ever been. There certainly is a lot of excitement with gold price. It's reflected in renewed investment from key individuals and in institutions. And there certainly is an air of excitement that there hasn't been around for at least 5 to 6 years. So, no, and I think that, with some of the unfortunate news in the world right now economically and with coronavirus, it's gold seems to be in a position to take advantage of some bad situations. So hopefully for the investors who are diversified and they have some gold holdings, I think it's going to be a good year for them.
Excellent. Tom, thank you so much for your time today and for updating us on Ethos Gold and its opportunities.
Thank you very much, Daniel. Pleasure to be here.
Well, let's talk about that cycle then, since you bring it up. is this coming year going to be the year for uranium, or is it going to be the next big thing next year? Like we've been saying for the past, I don't know, 5-10 years.
Gosh, it's so tough to pick a date, right? I've been made a fool of for years already, saying
You
that
and me too.
it's fundamentally time, and that's very true. You know, as I continue to look at it, and as I've continued to lose money in the space, I'll tell you a personal story. I mean, this is a podcast; that's what it's for, right? I just sold in the letter fission uranium. You know, I've had
Yep.
fission uranium in the letter since 2013, right? I owned a lot of fission uranium, had my parents in it, best friend in it, lost, 75, 80% of
Oh,
my money. And that's not to say that, it's not the best undeveloped asset of uranium in the world, but you can't fight the cycle, right? And I'm sure there's things that the fission that could have been handled better, and I wrote about that in the letter. If you want to read about it, you can subscribe. But the point is that you can't fight the cycle, right? And so even though you had the Chinese come in and invest 80 some $1 million at a substantial premium to market, and even though it's fantastic high grades 5, 6, 7, 8% uranium, and even though it starts right at surface, it really doesn't matter if the commodity price is at $25 a pound, and it's going to take you a different number to attract the investment, to get the capex to start to get it out of the ground, and then a number that you need to have profitability, right? And that's just not here in the current market environment for uranium. And so, and that's not to say it's all doom and gloom, right? I mean, there's been some wins, and if you're a quality speculator and you do good due diligence, you can win. Like, I mean, we financed Sky Harbor at 15 cents and we sold it for 155% win, right? I mean, you can still win in a down
Hmm.
market. But back to Brian's question, I don't know when the date is going to be. It seems to me that, I've been immersed in this sector for a bit now. We need the utilities, right? I mean, what else?
Yeah.
Everything else is lined up. If you don't have a buyer for your product, you have no market. Everything else is there. We've eaten through secondary supply. Trump has, trimmed down the permitting process, at least in the U.S. He just had a budget proposal last week calling for a stockpile. That's nothing concrete, but at least says, the administration is in favor of doing something for the sector. I could go on and on about the fundamentals, what's being built in the Middle East and India and China, and how we're going to be entering a deficit, or we potentially already are in a deficit, how prices have gone up for secondary refining, et cetera, et cetera, et cetera. But none of that really matters until the price of uranium goes up. And I don't think that happens until utilities start buying.
do you want to clarify what were those projects being built? You said in the Middle East and China. Are these state projects or national projects or private ventures?
Well, I think there's a mix of a lot of that, right? All of the above, but in China, certainly there's state-backed projects, and in the authoritarian regimes in the Middle East, there's state-backed projects as well. But I'm referencing just the sheer number of new nuclear projects coming online that are going to make the supply-demand numbers such that.
So why hasn't the price responded? I don't really understand the disconnect there.
Well, that's a good question.
Yeah. A
But
lot of
let's
people don't
unpack it.
understand it.
Yeah.
Right. I mean, and at the end of the day, I'm not sure I understand it 100% either. It's that one, I guess there's still supply coming from Kazakhstan, although they've significantly reduced prices. They produce at some of the lowest prices in the world, and so that's one thing. Two, the secondary market is very opaque, and it's tough to know exactly how many supplies are left and exactly how long it's going to take to work through them. Another thing is that I'll stay on the opacity of the market, is that it's tough to get information. And if you talk to really sophisticated investors in the uranium space that have done deep due diligence, talking with suppliers and buyers, et cetera, you'll get a sense that the information that everybody is making their decisions on might not be 100% correct and up to the minute. And I would be talking about like the groups that publish uranium prices and research on that market. And so a combination of all those factors, right? Opacity of information, not knowing how much is on the secondary supply, the nature of the way the contracts are written and the lead times, and how big players like Cameco now have to go into the market to buy, to cover contracts that they have, and the market not knowing when they're going to do that or at what price it's going to be. I mean, all this uncertainty, right? No firm decision from Section 232. All these factors, I think, contribute to the disconnect.
Yeah, it's a pretty shadowy market, Fergus. For instance, the Japanese utilities had a habit of stockpiling uranium for years, and then once their reactors were essentially all shut down after the tsunami, they had tens upon tens of millions of pounds sitting there. So even though there are restarts in Japan, they don't need any more uranium for a while. But more broadly speaking, around the world, it's been projected that utilities were running out of their stockpiles imminently, and it's been predicted imminently for the last few years, frankly. At some point they will, and they will have to go back into the market and buy, and there's just not that much uranium being produced to meet that demand. So it's going to have an inflection point at some point. We're just waiting for that to happen. If that $150 million a year in the U.S. federal budget is approved for Defense Department purchases of uranium, that's going to be very interesting, because that will essentially create a bifurcated market for uranium, and in that U.S. produced uranium will trade, at least initially, for a higher price. Now it's a somewhat liquid market, so that other supplies will fill in where those supplies weren't going, et cetera, so that premium or that separation will close over time. But over the longer term, there should be at least a significant premium for U.S. produced uranium if that portion of the budget gets approved.
Okay, Nick, well, we've raced through the half hour. Is there any comment you want to add, or do you want to respond to what Brian said there? We can round up.
No, I think that, uranium has its day. Eventually, there's so few names in the space that it's easy to pick when the time comes, and they're all going to go up measurably. And the market is paradoxical, right? We talked a little bit about that unintended consequences throughout the half hour. Mr. James Steins gave an interview last week talking about how there will be a time when environmentalists are the biggest champions of nuclear energy, and I believe that to be true, and I think that's going to coincide with a big bull market for uranium, whether that's in 2020 or 2022. I don't know, but I'll be here.
Right. If you want to subscribe to or just go and check out Nick's work, the website is outsiderclub.com. His Twitter is Nick C. Hodge, or just at Nick C. Hodge. Otherwise, Nick, I appreciate your time, and I look forward to seeing you at another New Orleans conference.
Thank you. I look forward to it as well.
Cheers, mate.
Thanks, Nick.